The most famous cryptocurrency, of course, is Bitcoin. Millions of people own Bitcoin today. It's a new form of money. It's used around the globe, and I think that's very remarkable. Its market cap has been above $1 trillion. And then there's another species of cryptocurrency called stablecoins, whose job it is to basically replicate or imitate major currencies like the US dollar or the British pound.
Stablecoins are crypto tokens whose values are pegged to a fiat currency, or really, I guess it could be to any other price. The most common type of stablecoin is one that is pegged to the US dollar.
The main use for stablecoins right now is for people protecting themselves against volatility. And that's really what stablecoins offer to people on chain, is just the ability to get out, more or less, without having to go into a Coinbase and go all the way into a bank account. And there's just a lot less friction that's involved when you have everything on chain and sort of protect people from volatility.
Say I want to convert Bitcoin to dollars and I want to put it back into my bank account, that's going to incur a delay. And so if I want to go back and trade again, I may not have my funds available when I need them. So stablecoins really emerged at the interface between more traditional finance and banking and crypto as a solution to this kind of problem. They grew tremendously as DeFi became more of an interesting and developed space in crypto.
DeFi, that's another word you'll hear bandied about in the cryptosphere a lot. It's short for decentralized finance. It's basically, replacing bankers and brokerages and middlemen with smart contracts so that, you're out there trading and there's no central clearinghouse, there's no person overseeing it. You're just interacting with these computer programs.
If you want to build any sort of advanced financial contracts on top of a cryptocurrency, you need to often refer to a stable reference asset. Right? Imagine a simple loan where I loan from you or to you in Bitcoin. Depending on how the price moves, you either owe me a lot more or a lot less than what we agreed to. So if we want to enter into a loan agreement, it's extremely useful to have a stable unit of reference like the dollar.
Of the three main categories of stablecoins, the one that is maybe the most kind of logical would be commonly called reserve-backed stablecoins. They have an amount in the bank that corresponds to the amount of stablecoins that they've issued.
So the total value of stablecoins right now, I believe, is roughly 150 billion. And that's largely made up between USDC and Tether. I think USDC and Tether make up about 75% of that number. So, a little more than 100 million.
When we created Tether, we did so because my partners and I were trying to trade crypto. And there were always times, probably at least once a week, when I would get nervous about the market and I would love to go into a safe harbor that was non-volatile. The only way to do that was to take the crypto I had, convert it all into Bitcoin, take the Bitcoin and transfer it to one of the few exchanges that had access to banking, and then trade my Bitcoin for dollars and have those dollars wired to my bank account. And by the time that happened, it took about 5 days, and I wanted to get back in. So our thinking was, what if we were in a crypto that was tokenized dollars? They can interact with crypto and you don't have to now cash out and go through all of those troubles of getting that done. Now, people always say Tether has some controversy because of its lack of transparency around its holdings. I'm no longer associated with Tether. I would like Tether, the operators of it, to be more transparent, to do more frequent audits, and yet people still use it. It's the most traded crypto on earth.
The next category that is widely used is one that is collateral-backed. And so that means that it may not be backed by US dollar or US dollar equivalent, but it's backed by some other crypto asset and is over-collateralized. So for instance, it might be backed at a ratio of 150%, meaning that the collateral you put up would have to be 150% of the dollar that you want to take out in the stablecoins. And if the value of your collateral falls below that ratio, then you would have to top up in order to retain the stablecoins that you took out. And these kinds of stablecoins tend to be more decentralized. They can be managed by smart contracts, and they also are somewhat safe in the same way that reserved-backed ones are, but they can have volatility at times of, for instance, like black swan events. Right when the pandemic began, there was definitely some pandemonium in the world of these types of stablecoins because obviously the value of the collateral had dropped precipitously. And the riskiest are known as algorithmic stablecoins. And those function in a way where there's a pair of coins, or even like 3 different coins, one that is pegged to the value of the fiat currency, and then the others have free floating values. Most of these, frankly, have failed. The most famous of all of these was an ecosystem called Terra Luna.
In economics, a bit like the laws of physics, sometimes you can defy gravity. And some of these algorithmic stablecoins, although really clever in their engineering, were very weak in their economic and market design. How did this all go wrong? On the way up, as the ecosystem grows, it's all fine. There's really no problem in that initial phase, and that's why people trusted these instruments without thinking too hard about the underlying economics. As you mint new coins, you're essentially taking value in and putting it in the reserve in the form of this equity token. But the challenge is that whenever you get a very large redemption, think of it as a classic run on the bank. People are tired of holding the dollar-denominated token and they want to get back their value, maybe to spend it on goods and services, or maybe because they're worried about the stability of the stablecoin. When that happens, the reserve finds itself into this impossible dilemma where it needs to sell more and more of the equity to meet redemptions, a bit like a central bank trying to cope with a massive economic crisis. When that happens, the value of that stablecoin quickly precipitates to zero because everybody's running, everybody tries to redeem, the process reinforces itself, and you get what is typically called a dead spiral.
People lost faith in the system, and so they were trying to exit, and so the prices of both just collapsed to zero. Maybe at one point there might come along some algorithmic stablecoin that actually works and doesn't collapse in this way, but all of them so far have not met a good fate. And after the collapse of Terra Luna, a number of people have been saying that the word stablecoin should actually not even be used for those.
So regulators are focusing on stablecoins probably as a whole, seeing the Terra Luna situation and saying like, okay, do we need to put some guardrails around who's allowed to make these things, what assets are allowed to back them, and things like this.
Stablecoins have been probably the most important coins after the original token, Bitcoin, have been the most important for growing the crypto ecosystem. If you consider that half of all Bitcoin trading pairs trade with Tether, that Tether today has over $30 trillion annually of trading volume. That shows you that the stablecoin concept, and Tether in particular, have been very well received.
People historically have always wanted to have their financial lives right where they're earning their money and spending their money. And if that's inside of a metaverse, if you will, then they're going to want all their assets kind of within that realm. And that's where stablecoins play a key role.
Until we have a better framework and more of the protections that you come to expect from, FDIC insurance that protects, your dollar balances up to 250K, those are the kind of things that will need to come into place for stablecoins to be truly useful for consumers, merchants, and for global commerce.